Welcome back to Infinite Banking with today's video. We're going to be talking about Ameritas, and we get questions all the time. What insurance company should we look at? We're doing a whole series on the different insurance companies and how they integrate with the Infinite Banking strategy and style and policies. And so we're going to be looking at Ameritas as an insurance company. We're going to look at ratings. We're going to look at how loans work, how PUA riders work. We're going to look at the pros. We're going to look at the cons. We're going to look at cash flow designs, front load designs, and even what it looks like for an agent to do business with this company. Alden Armstrong is the brains and the beard behind the series. You've put together this research, and so without further ado, Alden, let's jump in.
All right, guys. Well, Caleb, thank you so much for the intro. And as you can see on the screen, today we're jumping into Ameritas. Some say Ameritas, some say Ameritas. Just tell me what to do in the comments. I'm not really sure. All right, so something I'm going to point out about Ameritas is they are a true mutual insurance company. So founded 1887, they've been around doing business for a long time. Now, from that time frame, they started paying dividends about 1908, and they've had over 115 years of doing that consistently. So that's a great thing to be looking at for a mutual carrier with this type of policy design. They are, again, 100% mutual. So they're not a mutual holding company. There was a rumor when I first got started in the industry that they were going to become one. That didn't happen. There's always rumors, but just ignore those. All right. So some highlighted numbers that we like to keep track of over the years with these carriers is the dividend amount, the crediting rate, as well as another metric we've been introducing to the channel called the lapse ratio. So starting from the top, something that's kind of unique about Ameritas is they don't actually publish the dollar amount of their declared dividend. Now, there are several other companies that may not share the dividend interest crediting rate, that percentage, but most everybody else that I'm aware of gives out the dollar amount. There's some comments that I've gotten from Ameritas agents that they kind of believe it's because Ameritas is a small company, but they don't want everyone to know they're that small because they have really good marketing. So that could be part of it. I'll let you make that decision yourself. But as far as the dividend interest crediting rate, that's at 5.75% currently. And then average lapse ratio. So we've covered this a couple of times, but just to recap for everybody, that lapse ratio is indicating when a policy is surrendered. So you take that cash, put it in your pocket, walk away. A 1035 happens where we transfer it from one carrier to another, or the internal charges in a policy are greater than the cash value in the policy. So the policy eats itself alive and ultimately lapses. This number is indicating a per year percentage number of the cases in the books that are lapsing. Ameritas is coming in slightly higher than average in the industry for lapse ratios at this time. Looking at a 5.9, almost 6%, and the average is that 5.1% there you can see on the screen. Now, this is something that I really like about Ameritas. They have a very unique loan recognition. Now, Caleb, you and I did a video about Mass Mutual, and we kind of joked around there for a little bit how they used to be a direct recognition, now they're non-direct, and you can kind of pick and choose depending upon when you bought your policy. Ameritas is really the picky choosy carrier. They allow you at any point with their current whole life products to choose what kind of loan that you want, direct or non-direct. Now, they don't use those terms, but that's effectively what it is. It's a variable or a fixed interest rate loan that you can choose. We're going to go into a little bit more detail on that later on. And then the last thing that we like to look at is their ratings. So how do they stand up among their peers? COMDEX score is a really good score to help us understand the financial strength and safety of that carrier. So COMDEX is 5 different rating agencies. They put together a conglomerate score called the COMDEX, and it's out of 100. So what this is saying is that they are a 78, which is above average. Average would be 50. Anything above that, you're in a higher percentile. So what we're looking at, 78 out of 100. It's on the smaller side of the COMDEX scores that we usually look at for most of our carriers, but their AM Best rating is A-rated excellent. So that's a very good rating to have from the AM Best. The last thing I'll mention, then I'd love to hear any thoughts you might have, Caleb, is that Ameritas is known in our community, right, in our space for whole life insurance. So Ameritas is also very strong in the disability insurance space. Similar to Guardian, they have a large amount of revenue coming from something other than pure life insurance, which is a pretty unique feature.
Yeah, when I just look at this slide, obviously it's similar to One America and their maybe view of dividends, even though One America doesn't release their dividend rate. It's interesting to me that Ameritas doesn't disclose how much they pay in dividends, but they do the rate. So that's interesting. Would love to know the reason that's the case. The average lapse ratio is a little bit above average, but overall it's still in I would say a healthy line, especially when you're looking at averages, you're bundling a lot of different insurance companies into that. A loan recognition, I think, is really interesting, and I can't wait to get to that slide and discuss the difference between non-direct versus direct. I feel like that's going to melt some people's brains, and I'm excited for it. But I would say definitely the COMDEX score. If you watch this entire series, you're going to see a lot of COMDEX scores 90 plus. And I definitely would think, like, if you were in Ameritas, room trying to strategize, like what needs to happen, I would be curious what they need to do to get that higher. And it could just be a result of the size of the company. Like, you could be a perfectly run small company and still not get a perfect score just because of size. And so that might play a role. I'm curious if there's other things that also would be like a part of the checklist. They're very, very much known for being great in disability. And then also they have some unique health underwriting stuff as well that I'm sure we're going to get into. So overall, I think this is a great snapshot of the company.
Awesome. Thank you, Caleb. Now, since we're talking IBC width, right? So how does Ameritas actually view the infinite banking concept? Are their products good for it? Are they not? One of the things that we'll just point out immediately is that Ameritas has been very well known in the infinite banking space for about the last 10 years. They have increased their market share. They've done a lot more, let's say, support of IBC practitioners, IBC events, those types of events. Ameritas shows up for those in spades. Now, again, very similar to a lot of carriers we've talked about so far, they don't have any official endorsement. There's likely a lot of legal reasons for doing this for a large insurance carrier. And so while their products are actually very good for this type of strategy in certain circumstances, and the best product being the Access Whole Life, in my opinion, they do not openly support infinite banking. You will see, if you're in a symposium, a lot of people do right with them.
What I would say to this whole thing is, yes, the Ameritas is very known in the infinite banking space. Some of the top IBC practitioners do a lot of business with Ameritas. Ameritas also has a career side of the business. They have a presence in Birmingham, Alabama, and I know that Nelson Nash himself was very involved in that career side. And so overall, they have a lot of different influences. And while no insurance company will straight up say, we endorse this, I would put them at the top, if not near the top, with One America, with Lafayette Life, for just being like very supportive when it comes to this whole strategy.
Absolutely. And as we dive into the products, you'll start to see why it can be a very popular carrier for those who really like the traditional 40/60 design model. If you don't know what that is, we'll show you here in a second. Now, as we transition to look at some real illustrations here, there are two main ways that we build these insurance policies: cash flow and front load. I've got options for both that we're going to dive into.
Yeah, so cash flow is we're putting same amount of money every single year. Obviously, there's flexibility within that, but that's when most people think of the typical IBC style policy. They think of putting in every single year. And then the front load is you're putting up a lot of money up front. You're front loading the policy. As Nelson would say, you're getting a greater volume of capital growing, but then you're putting in less money over time. Both have flexibilities, but we in this series wanted to show the illustrations on cash flow and front load.
So when we're looking at the cash flow strategy as a whole, some highlighted numbers that I've seen as we've done lots of illustrations with this carrier is that in general, they are fairly strong in the early cash value if it's built in a certain way. So I have a small caveat here you'll see underneath, is that effectively the early cash value will decrease if you want to fund that policy to the max long term. I'll get into that in a little bit more detail as we look at the illustrations. This type of product, the way it's designed and how their PUA rider works, almost exclusively means that if we want to maximize efficiency, we're going to fund it on a short pay. So a short number of years before we have what's called a step down in PUA options, which I'll go into as well. The growth side, it's actually pretty good. So long-term growth, even for short pays or for long pay products, maintains a 3.2 to about 4.4, depending upon age and health rating.
So I would just say that is definitely more on the lower end when it comes to internal rate of return than some of the other carriers that we compared in the series.
All right, so as we pull up some illustrations to look at here, I did illustrate two separate cash flow designs. Now, why would I do that? One is because I want the product to look as best as it can based on the limitations that are there. So I built one of those. And then I built one that matches what we've been illustrating for this particular series. And so I'll dive into that, give you a little bit more explanation. But this first one, this is going to be very similar to what we've tried to do with the other carriers. Other carriers, we're going to illustrate $50,000 a year for 20 years. When we do that, we're trying to build it such that the cash value is very high. So we're putting the largest degree of PUA in the product as we can, the smallest amount of base premium that we can. What you'll notice with the numbers on your screen is that we start off with 50,000. After about 10 years, that drops to 40 and it drops to 20. This is not something I did manually. This is a step down of how their paid up additions rider works. So the reason I'm showing you this is the early cash value in this type of design, this would be pretty close to a 1090, is very strong, but you don't have that long-term optionality of funding. So I'm going to show you another illustration, and that's where we can do some more comparison because it's closer to apples.
Is there any other carrier that does something like this, Alden?
The short answer is yes. Many carriers have adjustments on their PUA. However, most carriers will underwrite a consistent PUA for as long as you want to illustrate it for. And then there may be some requirements to keep up with that. Ameritas won't even let you illustrate it. They stick to their rules kind of regardless.
Okay.
So from a comparison perspective, this is going to be that same 40-year-old male, 50,000 a year for 20 years. And the ratio of base to PUA here, because of the PUA that I mentioned earlier that we're going to go into in some detail in a moment, I have to increase it to allow for that apples to apples $50,000 a year funding that we've been looking at. So early on, we're putting in 50,000. Cash value is fairly low comparatively. It's about $33,000, comes out to about 67%. When we look at the long-term growth of this product as well, some other numbers to take a look at is when does it start creating more cash in that year? So the capitalization point that we talked about before. And then also, when's the break-even point? Looking at this illustration, we can see that the capitalization point is going to be right there, almost between years 3 and 4. So I'll highlight those numbers. Year 3 to year 4, it's about a $50,000 difference. Technically, it's going to be years 4 to 5. And then the break-even point on this policy is out here in year 8. So after we've put in 400,000, we've got just over 400,000 in the cash value. So something I will mention, and just to give Ameritas their flowers here, is we have a situation where they're going to purposefully illustrate something that has a fairly low likelihood of happening. And what I mean is that no other insurance carrier that I've seen illustrates a consistent and very honestly paltry dividend for the first 3 to 4 years. This is consistent across Ameritas whole life products. So what they're doing is they're deliberately putting in lower numbers than what they actually expect and allowing that to hit the illustration instead of their expectations. What this does for policy owners is, in reality, you get surprised at the end of the year, unless you're doing these videos and this kind of research, but you get surprised at the end of the year that the dividend is so much better than you had anticipated. So when we do 4 or 5 year lookbacks on policies, it is a larger dividend. Even when their dividend has been fluctuating, it's usually a larger dividend than what's illustrated. So these numbers, all the cash value numbers, and every insurance illustration we look at, you have to understand they're projections. And every company gives their own framework of how they want to project moving forward.
Okay, Alden, that's really interesting. I appreciate you breaking that down. Do we know what, if you actually did a snapshot of what they would pay, what this would be compared to? Because that's the reason why we do illustrations, is to kind of do internal comparisons company to company. And I would assume the IRR is also based on these assumptions. Are you taking the IRR range from real policies? The reason I ask is the IRR is lower compared to some other carriers, but that could be because they're factoring in 4 years like this.
Yeah, so it's a good question. What we're looking at here is just all projections. It's conjecture. It's what the carrier expects and wants you to expect. Now, in reality, like we said, they're paying more. Internal rate of return numbers that I put onto the previous screen that we looked at, those are based on illustrations and projections. So in theory, if you get the highest rating, you fund it just the right way, you could have a higher IRR, assuming the dividend doesn't change, because of these early years when the dividend is almost purposefully adjusted down.
It's interesting. I would love to hear people's thoughts in the comments. That'd be an interesting annual review to be like, hey, good news, you have more. It's like Christmas came early. I personally would rather see an actual real life deal, but I don't know how big of a difference this actually makes in the end, because even if you look at year 5, the dividend at year 5 in this example is 2,457. So I don't know if they make all of them lower than average or if they just start the first 4 years, but it may not be as low as we might be, taking on. So who knows?
It's a black box. Yeah. We don't have the keys for it. So it's all conjecture at this point.
Heard.
Awesome. Well, looking at the illustration, some numbers for those taking notes, and this is a hard illustration to compare to other carriers because of the limitations I mentioned. But if you want to take notes, we can look out that cash value number. It's about 1.42 million after 20 years. Death benefits about that 3.31 million in the same time frame. So Caleb, let's go ahead and pivot over to the front loads. So for front loads, it's basically the same story as the cash flow, right? We can get a higher early cash value percentage-wise if we don't want to fund it for as long. And so same story, 80 to 90% just depends on the funding time frame. Short pays is what I would typically build or recommend with this carrier. Otherwise, we would just choose to go elsewhere. And then long-term growth is good, but as Caleb said, it's kind of on the lower side of par for the carriers that we look at and work with. Now, jumping in here, this is going to be an example of the best cash value we can get in the very first year for a front load. And then over time, you're going to see that same step down in premium because of the carrier limitations on the paid up additions rider. So in this first year, for this 40-year-old male, one level above standard, we are looking at around 88% cash value projection by the end of the first year. And I find it interesting just the way this particular product works. When we were putting in $50,000 per year, the dividend, even though it's decreased, was higher. Now we put in double the money and it's lower. I don't know what they're doing. I don't know why they're doing it, but it is a little bit confusing. So because of the amount of base premium, so the whole life insurance I'm actually purchasing in this policy is very small. Because of that, they allow me to fund with paid up additions at the level I want of that 50 grand per year for about 5 years. Then they drop it down and they do that every 5-year increments, as you can see. So 48.9, 35.1, and then 18.5. So this policy, it's not apple to apples. This would be an example of why we might choose to stop funding in year 10, for example, if we wanted to maintain this funding style and then just let the policy keep going. So bringing over the actual apples to apples, as I said, I've had to raise the base premium to allow me to fund the length of time and show the length of funding of 50 grand per year that we've done for the other carriers. So you'll notice the first thing, we have a big hit in the early cash value. About $9,500 get pulled off the cash because now we have to put that into base premium. Year over year, as we look at this, you'll see that that $50,000 stays because I have the right ratios involved. What sacrifices, though, is the efficiency of the product. So when we're looking at this particular policy, those 2 points that we look for, right, it's the break even and the capitalization point. That break even point is going to be out here in year 7. So at this point, we've put in just about $400,000. And we have just over $400,000 available in cash value that is projected, of course. As far as the capitalization point is concerned, it gets into year 3 and year 4. So the jump between this year to this year is greater than the premium we paid. So it's increased more than $50,000. So that's the capitalization point where we've kind of overcome the cost of insurance. And now we've got a savings account on steroids with state benefits and a whole lot of other stuff going for it, which is pretty sweet. So typically what we see with front loads in the insurance industry, which we are seeing here, is that when we front load an insurance policy, because of the way that we're doing it, we're buying a lot of cheap death benefit with term insurance, it's going to accelerate our break-even point as compared to funding a cash flow design. So if we remember from the other illustration we just looked at, it's brought our break-even point 1 year sooner and our cap point 1 year sooner as well. So the product itself early on is still more efficient than the typical cash flow design. It's just not as optimal as we might be able to make it for long-term funding.
Yeah, a couple of observations I'm making is early cash value in a front load is, there's cash flow designs that could beat that. So that's an interesting deal. The capitalization is a little delayed when you compare to other carriers, and then a 6-year break even is not necessarily blowing anyone out of the water, especially when you talk about front loads. Or is that 7?
7 year, actually.
Yeah, so I'm staying corrected. 7 year. So 6, I was correct. 7, my point made even more. And so, yeah, that would just be my thought. And it sounds like, and this is something that we're not necessarily getting into this series, but it sounds like the base premium needs to be higher in this design than others, which is another code for less flexibility potentially. And so that would just be like an observation that I'm not sure Ameritas would be the go-to carrier for front loading. And also when it comes to philosophy wise, I know that in Nelson's book, he talks about like dropping PUA riders off. And so there could be some people that like the idea of in the future, they pay less, but anyone that can contribute to a policy, their first policy, later is going to have greater efficiency than starting new policies. I'm not saying new policies are bad. That's a great first world problem to have, but I would rather contribute as much money as I possibly can to a policy that's 10 years versus 2 years, because 10 years is a lot more efficient. And so that's another thing where it's like, some people really like the idea of like it gets lower and lower. I like the flexibility to not have to pay, but I love the flexibility of being able to pay as much as possible. That's just an observation I'm making, and it doesn't make it anything right or wrong. It's just an observation I'm making when I look at these illustrations.
So because this is the apples to apples comparison we've been doing for the series, let's bump into those numbers down here at the end. So we've got, at the end of 20 years, we're looking at a projected 1.51 roughly million in cash value, and then a death benefit about 4.3. Now this is going to go into a larger video we're going to do at the end where we compare everything, start looking at the cross carrier comparisons and where each carrier really shines. So when we start talking about access to cash value, the theme of this entire series, in my opinion, is the more business that practitioners, so people who really sell these types of policies, do with a carrier, as compared to the volume of insurance that they sell, the better access we're going to get and the faster. So with Ameritas, we were able to get to loans within, I've actually been told, 10 to 21 days. So 21 is closer to the average. That's really fast. Most carriers were having to wait at least 30, some closer to 45 with the big insurance carriers before we can initiate a loan. So you can tell a lot of insurance brokers or agents are using Ameritas for these types of quick access cash value policies. We've mentioned this briefly before, and I've got another slide on it, that there is a flexible loan recognition. We'll go into more detail there. Loans can be initiated through the portal up to a certain dollar amount, and then larger loans, just like almost every carrier we've talked about, you need to go directly to the carrier or work with your agent to get that loan initiated. Now, this is our favorite type of loan interest accrual. It is a daily accrual interest rate, and it's based on the annualized rate that we've been quoting, and it's going to be added to a daily recurring balance.
Alden, you made a point that I think is really awesome that we kind of like highlighted as we go through this series is, on one side, the bigger companies can say, hey, we got really, really great ratings. We have a lot of money, kind of like can play the size game. And maybe the trade-off is they're maybe not as caring or loyal or plugged into the infinite banking space. And there can be, with what some benefits come, there can be some like trade-offs from like even like working with their home office and like working with getting loans and having speed there. Whereas like some of the smaller companies that again, every company is massive when you think about it, but in relative to like the New York Life, Northwestern Mutual, especially the ones that are like, we love this type of business, they tend to have people in the home office that are familiar with this, that don't just like stare at you or like have a long pause over the phone if you're like asking, like they actually know this is business. And so I definitely think there's a ton of value, not just from an agent, but someone working with a company that gets that. And there's usually trade-offs. There's very few that, I don't know if there's any in this series that are like, yeah, this is like one of the biggest companies and they're one of the most supportive. It's usually there's some type of trade-off. Doesn't make it right or wrong. That's a theme that I've been seeing going through this series.
Yeah. You're exactly right. And I think this is another place where Ameritas kind of shines to this particular community. There's been a lot of debate in the infinite banking community about which recognition is acceptable for these types of designs. Our opinion of BetterWealth, if you've watched the channel, you kind of know this, is that it kind of comes out in the wash. If I had a crystal ball that could tell you where interest rates are for the next 30 years, I could plot that in a line. I could mathematically prove which direct recognition or non-direct recognition is better. But because they can't do that, it's a wash. When interest rates move, one may be technically better in that policy year than another. Now, Ameritas, they give you that option. And so they're allowing you a fixed loan option. And it's actually fairly low. The other carrier that we work with that offers a fixed loan rate at direct recognition is Guardian. Guardian's loan rate is 5%. Ameritas coming in with a 4% uppercut here, which is pretty cool. This is also guaranteed currently on their whole life products to never increase. So it's locked in for the entire time on the product. Now the caveat, and this is where direct recognition can shine or be a hindrance. If we have another situation where, like we were in the 80s, when I wasn't born, in the 80s when interest rates were up 15, 16%, and you have this really cool feature of borrowing at 4%, well, the carrier is not going to lose. They're just not going to pay you as much in dividend. So that's why they have that direct recognition feature on fixed loan options.
Do we know how that works, or are they not super public about how the direct recognition or the direct recognition works?
They're very public about how the dividend will be affected, but they're not able to. I don't think any carrier would be able to write specifically how it's going to affect it to pay depending upon interest rates, right? That's going to fluctuate over time. Because at the end of the day, that's something that one of my mentors told me is that insurance companies don't lose. That's why we sell their products and why they've been around for 200 years and you haven't. And so in that example, they will do what they need to, but you get the benefit, right, of having that really low guaranteed loan rate at 4%.
Yeah, that is something unique about Ameritas. That's 4% fixed. That could be very advantageous, especially if you're an entrepreneur having the gears turn. But there could be some cases where it may not be as advantageous if it really affects your policy. Because I want to remind people that now I'm getting into maybe area that I shouldn't get into, but the best type of returns that you can make are in an insurance policy. Like it's not going to hit any home runs, but if you can really start stacking cash value, like cash value is more valuable than cash. And so I would want to make sure that I'm not doing anything that hinders like it majorly. But if we're talking like a, few $1,000 difference, not a problem. But if it's like a big difference, I would rather pay with cash and increase cash value, if that makes sense. It's cool though that they give both options. And when you go through the process of deciding, you can very much compare at that time. So I'll let you talk about the variable policy loan.
Yeah, well, the variable is very simple. It's going to change. And because it's changing with the environment, the dividend that you're being paid is as announced. So it's not going to affect your dividend at all. Now, the interesting thing is that utilizing one of these loan structures is kind of an exclusive. So if you have an outstanding loan and it's on a fixed rate and you want to pull another loan at a variable rate, they just don't allow it. You have to pay off one existing loan of a certain type before you open up a new line. But theoretically, you can jump back and forth year to year just depending upon when you pay that loan feature back.
Really? So you could be within a policy and not have an outstanding loan and then choose at the time if you do variable versus fixed.
Yes, Gab, you're exactly right. You don't have to choose at the beginning of the policy. You can choose year to year as you need to.
It's awesome.
Now, this is something that I really am passionate about. This is the flexibility of the contract itself. So paid up additions, that's the or, right? Or the option or the and, if you will. When we're putting money into the insurance contract, it's not a technical requirement. We're choosing to do it because it's going to accelerate the compounding of that particular product by adding to the death benefit, and the byproduct is adding more cash, increasing that compounding base. And we've gone over many different carriers at this point, and each of them are a bit different, just depends on how they choose to set up their PUA rider. There's some interesting aspects with Ameritas that I want to dive into with you today. So the first is that there's a high upside on paid up additions. I mentioned to you that the 40/60 design, the very traditional IBC design, is a kind of ideal for this carrier because you can build it. Not all of them I've unfortunately seen are built this way, but you can build 40/60 designs where you have 40% going toward base, 60 toward PUA, and then the carrier allows you to effectively double, pay up to 100% more into the PUA rider under the MEC limit at any time. So that's a very good flexibility for room to grow policies. Now, with any insurance carrier, we have an aspect of restrictions, right? Something has to be done in order to keep the rider alive and still operable. So first things first, if we illustrate $100,000 going into the policy in year one, and then come funding, you're like, actually, I can only do 40. We got to rewrite the policy. We have to restructure it because they're expecting 100% of that scheduled PUA premium in the first year, unless we do some finagling with the insurance company. After that first year, however, you do have some flexibility. The rule, though, is you have to, in one of the next 5 years, so it's a rolling average of 5 years, in one of those 5 years, you have to pay at least half of what has been scheduled. For those who've watched the channel before, this is similar to Penn Mutual. However, the big difference is that, for example, you've got an optional $50,000 of PUA scheduled every single year. You can put in 4 goose eggs in a row, and starting year 5, you got to come up with at least half, so $25,000. That same story is true if you skip the first 2 and the last 2. That middle year, you have to come up with $25,000. So they don't take an average. It's a per year thing, just over a 5-year time frame.
So that's interesting. How would you compare this to other carriers, just without naming names? Like, would you put this more flexible than the average carrier in this series?
Well, I'll name names because I'm out here doing this review. So it's more flexible than Mass, less flexible than Penn Mutual and One America. I think it's nice that they give you that ability to pay 0 if you need to. but having to pay, and you've mentioned this before, a large premium just to keep it alive can be difficult. But also, if you were planning to pay 50 and you're coming up with zeros, there's other problems outside of the insurance contract. So flexibility is important, but let's make sure we get the right policy size for the right person. So last thing in the restrictions section here, guys, is that your scheduled premium, it will reset to the highest payment you did make in that 5-year period if you don't make that 50% number we just mentioned. So kind of keep that in mind as you're funding. Talk to your agent about that as well. Now, this is the area of the paid up additions rider that is unique and kind of cumbersome for an agent like myself when I'm building these policies. It's restrictive. And so we have a mandatory step down feature. This is similar to a couple other carriers that do something similar, but as Caleb mentioned and brought up before, most carriers we can underwrite and approve above the step down. With Ameritas, they mandate that has to happen. So in the first year, we can put in 25 times the base premium in paid up additions. Amazing. That's really, really helpful for front loads. Through year 5, we can do 10 times. So there's that 1090 design that we could do. Starting years 5 through year 10, they shrink it again. 7.5, 10 to 15, 5, and then 16 plus, only 2 times is available for additional funding the PUA rider. Therefore, I don't think this is the right carrier if you want to fund long term. Now, there are IBC practitioners, and people may show up in the comments and disagree with me on this, which is okay, that say that's actually the best way to do it because the base premium is the most efficient. I've done a video on this before, kind of talking about why I disagree with that, but the stance remains. If you want to overfund the product for as long as possible, this isn't the right product. If you're okay with short funding and then just paying base, this is kind of why this product exists. It was designed for that purpose.
And if someone wants to play devil's advocate with us and debate that, you're welcome to come on the channel and we can compare that, because Alden and I are both open to being wrong or changing our viewpoints. But yeah, that is a head scratcher, Alden, around like they got a lot of things going, but this really makes it where you almost need to increase your higher base just to compete with our original illustrations, and it almost designs from day one to like slowly drop off that PUA, which is interesting. And I would just be curious to hear the pitch to why that's a good thing.
My opinion on this is actually it's a design from the insurance carrier to ensure their agents can go out and sell additional policies in the future. What I see a lot of, and in my opinion, is if we build it right the first time with the right carrier and the right product, you shouldn't have to buy another policy for funding, right? Maybe for death benefit protection, but for funding in the next 5 to 10 years, right? If we do, then likely I didn't do my job right, in my opinion, very first time.
The caveat is if you make more money, if there's a lot more money going in, but if you have a net, if you're designing for $50,000 going in, I agree. 20 years from now, that 50,000 would be better off going in that original policy than on policy number 3. But if you exit a business or start make more money, and now you have a first world problem of like, I have 30 grand more that I would need to save or want to save. We're not saying multiple policies are not great. We're just saying like the first 50K would be more efficient in policy number 1 if it had capacity. Like no one, or it would be very rare for us to say, instead of paying in your first policy, let's start another policy. And again, if you disagree with this, love to have you on the show. But I mean, we've run lots of different scenarios, lots of different ways. And I just don't, I think your summary, Alden, which we'll keep it in, is an interesting summary. And I think it's not that far off, to be honest.
Yeah. I'd love some dialogue around that for sure. So where we are now is we just need to understand this particular product has some limitations. So now we're going to jump into some things that I just think you should know about Ameritas. So first off, they have a simplified issue product via a separate company that they own called Ethos Life. So I've actually had some clients before they came and worked with me that have gotten insurance products, whole life insurance products, term insurance products, universal life products through Ethos Life that are simplified issue, meaning no medical exam and very limited underwriting. So the question becomes, how can an insurance company do that? There's going to be a little bit difference in the cost. So you're buying a whole life insurance product, but it's going to be less competitive and more expensive than a fully underwritten product at the same rating. So that's something to be aware of. But it is nice when an insurance company makes it a point to make insurance and the obtaining of that insurance for families easier. I am all about that. 100% hands down every single time. But there's going to be a trade-off for you. Now, disability waiver of premium. This is one of 3 companies that we work with that has a waiver of premium that can include paid up additions that are scheduled on the policy. There's an extra cost, but that does exist. Now, Ameritas Life Insurance Company of New York can, thankfully, work in the state of New York, which is pretty great. And then this last one, this is just unique and this is just cool. I really like this about Ameritas' product. They have a care for life couple of riders. I don't know how they classify it, but effectively, almost every insurance company that we work with has a terminal illness accelerated death benefit rider. Most of them then also have a chronic illness accelerated death benefit rider. And then Ameritas comes in and says, hey, I'm going to do another one. Let's do critical illness. And so now we've got 3 different ways to access policy values in the event of certain circumstances that are classified under critical, terminal, or chronic illness, which is really unique. It's the only product that I know of in this industry that can be attached to whole life that gets you all 3 of those.
Yeah, I feel like this is a huge plus slide for Ameritas. The care for life, love that. And I think that's very, very hard to put into words, like into like even like an illustration or an IRR calculation. But like that's great. Love the fact that it can work in all 50 states. The disability of waiver, that includes PUAs. Awesome. That's great. And you even said that, Alden, where only 3 companies, that we've covered have that option. And then just the fact that they have other companies in their ecosystem that does simplify the issue. I mean, I've definitely heard of Ethos Life. That's better, more mainstream brand. So that's good on Ameritas.
Yeah, absolutely. So now, guys, as we start to land the plane, let's talk about the advantages. What are some things you should be aware of as we look at doing business with Ameritas? First of all, great mutual dividend history, right? 115 years plus moving forward. They do have that really cool direct and non-direct loan feature. And in my opinion, they do actually have some good PUA flexibility kind of on one side of it, right? You'll also see that show up in the cons section for the other reason. But so we're kind of playing both sides of the house here. The fact that they are fairly pro IBC and a lot of IBC practitioners work with them, it means that they're going to understand your business, understand your underwriting, and a very good chance that they're going to understand you as a policy owner wanting to leverage that policy quite often. Last thing I'll mention, Ethos and then the strong disability arm, that diverse income and market exposure, I think is pretty strong for Ameritas as well.
What I would say is that love the dividend history, love the non-direct versus direct option. I think that's really neat. And I just love that they do that. I don't know if I would put the PUA flexibility into that category. I think you might, you're generous there where I wouldn't put that maybe as a disadvantage, but maybe middle ground. Love the fact that they're pro IBC. I think that matters. I would also add that care for life. I think that's a big advantage and just really, really cool that they do that. And then obviously it's cool working with a company that does disability as well, because there's things that you can become more efficient just even in that area if you do DI as well. So overall, a lot of advantages when it comes to Ameritas.
Yep. That's awesome. All right. So some considerations, what you should know before you do business with Ameritas. The PUA rider, while it is flexible in that you can double your premium without extra underwriting under the MEC limit, which is pretty cool, because of that step down, the funding timeframe is just rough. Right? You don't have the same options for long-term funding as you would with most carriers. They do also pay different dividends depending upon the state that you're in. For New York clients, they get a dividend. For the other 49 states, they get a separate dividend. So that is just something to consider if you live in the state of New York. The carrier rating itself. So the lower COMDEX of 78, this is just something we need to bring up because the vast majority of our carriers are 93 and above. So Ameritas, we have a good relationship with this carrier, right business, but it's also on the lower end of the rating scale from a safety and liquidity standpoint. So something to be aware of. So another consideration is just that they don't publish their dividend dollar amounts. That's just a unique feature of this particular company. They don't share that information. Some people don't like that. We don't really think it matters that much because we can see behind the scenes of how the company works, their profitability, all those different things. But that is something to be aware of. And the last thing that I threw in here is that in general, Ameritas does have a little bit more liberal underwriting practices. We've gone through some examples with clients where we get declines at some carriers and then Ameritas picks us up at preferred. And so that liberality, if that's a word, can be a good thing. It could also be a bad thing. Maybe that can speak into their COMDEX score as well. I don't know, you tell me. Caleb, I think you mentioned before the show that you have had some comments on the underwriting perspective as well.
Yeah, it's interesting that this is a consideration. I get where you're saying this is a consideration because you're like, hey, if these companies won't accept this person or will give this person a negative rating, and Ameritas gives them a positive rating. How's this going to shake out in the end? So I think that's a valid point. But on the flip side, I think from our perspective is like, hey, if we can get you an optimal rating here as a consumer, that's great. And I understand that it's like the real preferred plus people are like, Caleb, stop talking, don't add. But that makes Alden's point exactly. So I think we use Ameritas or Ameritas. You tell me how to say it right. And it's we've used this in the past because of that same example of like looking at getting someone a better health rating. And so in those examples, it's great for our clients, but how is it going to shake out in the end? And then I would just say the other thing that I would say is the funding time frame. I think is a major consideration, and maybe the reason why it's maybe not our number one company and top choice when it comes to we're big on let's have lots of different companies that we work with, but I think that's probably one of the big reasons. And then I would say that this isn't a consideration; it's actually more of an advantage. Like how they do their illustrations, I like the fact that it's conservative, but I also think it's frustrating because when you're trying to figure out what companies to work with, we want companies to try to be as close to what they're actually going to do. And so that's also, I think, an advantage that you could actually say, but it's also could be a disadvantage that their illustrations are maybe not as competitive, which not just goes into the funding time frame, but also just goes into their more conservative nature, which also could be an advantage. So I know I'm kind of playing. A lot of these things are not so black and white. That's why we are doing this series, is to talk through it, because this will also be in writing, but in writing, we're going to miss a lot of the conversation.
All right. So to finally land the plane here for the agents, for those watching, I used to be on the outside. Now I'm here, and we're looking at an agent perspective for this particular carrier. So some things to understand very briefly is that compensation is basically average, right? Most companies that work in the state of New York have average compensation because there's some legal ramifications of paying too much or too little. Now, compensation tracking can be cumbersome. This old carrier, they're still kind of coming up to the newer ways of doing things. A lot of the carriers we work with are in that boat. Been around for 200 years. Apparently you don't grow as quickly. And then on the GA and career contract side, this is actually pretty cool. They have some very unique perks. And so I won't go into details here because I'm not on the inside. I can't speak to it, but I have heard is that on the career system, you do have the ability to set up dental plans and healthcare plans and other aspects of things that a traditional insurance agent, a broker, wouldn't have access to unless they paid for everything themselves. Ameritas kind of foots that bill depending upon your GA production level, which is pretty sweet. Support and resources, agent access to resources and support, I'd say, again, it's average. Good mutual carrier. They have a lot of people that are willing to talk with you and work with you. They're not massive. They're not tiny. They're kind of right there in the middle, which is good. Now, one thing I do like about Ameritas is that they're very easy to understand. Their illustrations, their products are easy. The only complicated thing, in my opinion, is they've got that step-down PUA, but it follows a table and there's no exceptions. So 4 out of 10 on that consumer complexity test. And then finally, this is just my pet peeve because I like spending hours in illustration software. It's a little clunky, a little out of date. Would be great to get a serious overhaul on that. But because it's straightforward, it does make the learning curve with that carrier pretty easy. To wrap things up here, so where do we land with Ameritas? So I think overall, Ameritas, it's a very well-rounded insurance carrier. Now, their products, they can be flexible. The whole life, it does grow quite competitively. And their overall financial strength is really the only thing that has a concern for some agents, right? The liberal underwriting could be a pro, could be a con, as we said. But because of that, some agents just get a pause before doing business with this particular carrier. Now, this is something, and I love my friend Malcolm for saying this, but the product, right, and its design and your understanding are what matter most. If it's a top mutual insurance company and you're buying a whole life product, over time, you're going to average a really good rate of return because all these companies are competing with each other and they're getting profits from the same general places. But you need to understand what you're buying and understand the limitations.
Who would have thought Malcolm X is so wise? It's a great quote from him.
I know, he's got a great head on his shoulders.
Yeah, I feel like that's a good conclusion. And I feel like we've been pretty consistent in this whole series, trying to be as honest as we possibly can. But we also know that there's a lot more to the story. With every insurance company that we're going through, we're trying to do our best. But also we know that there are lots of different ways to approach any type of scenarios. If you've been watching the series and you're like, I have an Ameritas policy that I want to get reviewed, or I'm actually would love to work with your team to figure out for myself, like what does a life insurance policy that can be optimized for infinite banking look like? We would love to help you or help you review your policy. We'll definitely have links down below. And if you found this information valuable, like we've put a lot of energy. And when I say Alden's put a lot of energy into this series. And so liking and subscribing are 2 free ways to tell YouTube that our content's been valuable. Commenting, sharing are more. And if you are subscribed to the channel, if you hit the notification bell, we're going to be doing more content. And then stay tuned for our comparison video where we compare all the insurance companies in one video. Alden, my mind's going to melt in that video. Yep. It's going to be lots going on, but I think it's going to be a really fun one to do. And so overall, appreciate the energy and work that you put into this. And I look forward to evolving this series as well as the companies evolve.
Absolutely. Well, Caleb, thank you so much for your time. This was a great series. Really happy that we did this. We'll see you guys later.
If you're serious about using whole life insurance for infinite banking, we have a free gift for you. It's called the IBC Company Guidebook, and it gives you inside access to the data behind these videos. Things like life insurance company COMDEX scores, their dividend performance, how they approach infinite banking style policy designs. It's all the information we cover in these videos organized in one place for easy reference. To access the guidebook, click the link in the description or pinned comment.